There are 29 banks in the world that regulators have formally decided cannot be allowed to fail. Not will not, cannot. Regulators do not put banks on this list based on instinct. They measure them. The Financial Stability Board, the international body that oversees global financial stability, scores every major bank across 5 categories. First is size. How large are its total assets? Second, interconnectedness. How many financial institutions depend on it, through loans, derivatives, payment systems, and so on. Third, substitutability. If this bank disappears tomorrow, could another institution step in and perform the same functions? For most banks, the answer is yes. For these 29, the honest answer is not easily. Fourth is complexity. How many legal entities, products, and jurisdiction does it operate across? Fifth and last is cross-border activity. How embedded is it in economies outside its home country? Each category produces a score. The scores combine, cross the threshold, and you're on the list. The designation is called G-SIB, Globally Systemically Important Bank. It's like the plumbing in an old building. Most pipes you can repair or replace without much disruption. But some pipes are connected to everything else. Touch one of those and half the building stops working. G-SIBs are those pipes. The financial system was built around them over decades. You cannot simply remove one. Being on this list creates real obligations. G-SIBs must hold additional capital, reserves that exist specifically because their potential failure is considered a systemic risk. The higher you score, the larger the buffer you are required to hold. Now this is where it gets interesting. To hold more capital, these banks must be more conservative in how they deploy it. But they also need to remain competitive, which means continuing to grow and diversify. Now, growth creates complexity. Complexity increases their score. A higher score means a higher bucket, and a higher bucket means more capital required. The system creates an incentive to become more systemically important over time, not less. And the larger and more complex these institutions become, the harder they are to manage when things go wrong. The list was designed to make the financial system safer by identifying the institutions that matter most. What it also does, a bit more quietly, is make these institutions very difficult to resolve if they ever need to be.